Hey everybody, it's Terry YUEDE with the YUEDE team. We want to first of all thank everybody for taking the time to dial in tonight and listen to our webinar. We have some great information, and we certainly want to welcome our guest speaker tonight, Mike Favazza, CPA with Favazza & Associates. Mike, can you hear us okay?
Yes, I can. Good evening.
Okay, very good, very good. Thanks so much for joining us, Mike, and we appreciate the information tonight. Now, tax advantages of owning real estate, we feel like that this is probably one of the more overlooked aspects of running an investment business. Now, I've been in real estate for about 11 years, and I've brokered real estate for about 11 years. And I was young when I first got into the business, for sure. Right. And end of the year rolled around. After my first year, the broker said, "What? You need to go talk to your tax professional and get your taxes prepared." So, I went in and met with the CPA, and CPA gave me a tax bill, and I'm like, "What? I got to get some of this money back?"
Yeah, no kidding. Who's got to deal with this?
Yeah. Oh my God, I actually got to pay taxes. So, it's definitely been a learning experience for us as far as preparing our taxes, is learning how to prepare our taxes. And, Mike and his company have helped us tremendously with that through the years. No doubt about that. And another thing that we've certainly learned is how much owning real estate can help you with your taxes. If you're looking for write-offs. And depending on what your goal is with real estate, obviously cash flow, making money on turning the property. I mean, the deals have to be profitable, right?
For sure. But the tax savings are very nice, too. It is an aspect that a lot of people don't consider.
And I think it's just something that people tend to overlook a little bit. So a little bit of housekeeping before we get started tonight. Everybody out there listening tonight, we want to invite you guys to, if you're members of the iTunes store, you can actually go to the YUEDE team broadcast on the iTunes store, listen to all of our podcasts, listen to our webinars, and then you can find our webinars also on YouTube under YUEDE Team Presents.
Doing these webinars and these presentations is something that, number one, we enjoy doing it. It's something that's fun for us, something that we get into. It kind of makes us or enables us to continue to try to take a close look at the market. Trying to figure out what the real estate market is going to do is not an easy thing. There's no doubt about it. And it's been a real roller coaster the last couple of years, but something that we've been committed to do, and we're going to remain committed to doing this, is we're going to seek as much information as we can. We're going to try to gather as much info about the market here in St. Louis and St. Charles, and we want to get our arms around it. The reason being is we want to be able to make good decisions in our business, and we want to help our clients to make good decisions moving forward into real estate.
I think investors in general, I mean, maybe not even real estate investors, people that are invested in stocks and bonds, I think a lot of people are kind of throwing their hands up a little bit over the last several years, just not knowing necessarily what to do.
That's something that we've been talking about for sure. Last year, too, this year is all the cash on the sidelines. I heard like $1 trillion in private equity. There's a lot of companies that are hanging on to their dollars right now, and one of the big reasons why is nobody knows what to do with it. Nobody knows what to invest in right now. We see real estate, right now as a very good long-term investment. We think it's a great time to get into the market. The market's beat down. The interest rates are still low, and you can even curb your portfolio against inflation. Whereas if you have your dollar sitting in the bank, that's good. There's nothing wrong with that. But what happens if the price of the dollar starts sinking? We all think that it will. It's kind of not really when, but if that's going to happen. We think putting some of your money into real estate is going to be a way that you can protect yourself against some of this inflation.
Yeah, as a matter of fact, a recent article, there was an interview with investor billionaire Warren Buffett, and it was back in February, and he basically agreed with what we're saying. He said investors, now is a great time to put your money into residential real estate if you can make it work.
Yeah, and that's a big if.
That's a big if. It's definitely a big if. And working with people that have experience in the industry, whether it's your CPA or your lenders, that's going to put people ahead of the curve, for sure. So let's get right into our material here. We're going to start with a quick market watch. The number of underwater homeowners grew by about 400,000 during the final 3 months of 2011 to 11.1 million. As home prices fell as a result of seasonal declines, slowdown in processing homes through the foreclosure process. This is according to CoreLogic. So 11.1 million homeowners underwater.
the high number of defaults look like that's going to be something that's going to continue. There's still going to be people that are going to opt not to pay their mortgage, whether it's they're feeling it because of the recession, maybe they lost their job, maybe they're just so underwater in their property that they don't want to continue to pay it. But that the high number of defaults is something that we see as something that's going to continue.
Correct. And even though the number of foreclosures are down nationwide, we're probably still going to see a bunch in the future. So
foreclosures are probably going to remain in the marketplace.
Yeah, get ready for it. I think it's just kind of the new norm. I think people just need to expect it at this point.
Absolutely.
And the latest pending home sales index from National Association of Realtors showed promising results this month with pending sales in upward movement. This is the highest point seen since April of 2010 when buyers took advantage of the first-time home buyer tax credit.
And looking back on that tax credit, that just killed us. Whenever they pulled the tax credit, it was almost like that was the final nail in the coffin of the real estate market. It was almost like the market slid off the cliff at that point. It's almost like as being in real estate and doing it every day, we're just now starting to get over it.
And that's something that we definitely felt regarding the tax credit. Is the tax credit worked real well in 2009, and then they came out with another one in 2010, and it didn't work as well as the first one. It kind of felt like they were kicking the can down the road a little bit. And, I really think that we paid for it a lot in 2011, which was a really slow year.
It was like the tax credit that wouldn't go away. It was really crazy. And now that it's over and the dust is starting to settle, we are starting to see a little bit more of a seasonal market in real estate, which as far as we're concerned, that's a good sign.
Yeah, and the good news is that the number of transactions is up. Lawrence Yun, NAR chief economist, said, "This is a hopeful indicator. I'm going into the spring home buying season, giving more favorable housing market condition. The trend and contract activity implies we are on a track for a more meaningful sales gain this year. With a sustained downtrend in unsold inventory, this would bring about a broad price stabilization or even a modest national price growth, of course, with local variations."
I think it's going to be we're going to wait and see on that.
I agree.
Because of the large number of foreclosures still that are going to hit the market.
And one thing that we've talked about is the fact that the real estate decline that happened in 2008. I mean, that was a national phenomenon. It affected every market in the whole country, affected markets outside the country even, where the houses coming back and starting to do a little bit better. That's probably going to be more of a regional thing, where certain cities are going to do better than others. And we're starting to see some of that where we have some cities in Texas. I mean, I guess the real estate market's really good down there. Yeah, Washington, D.C. is good. So I think it's very important, and this is kind of what I think Mr. Young is saying here, to really take a close look at your specific market.
Real estate's always been a local market, so it is what's going on in your own backyard is really important.
This is foreclosure activity, January 2012. Foreclosure rates edged up. Indication rut may be over. Banks took back more U.S. homes in January than in the previous month. The latest sign that foreclosures are accelerating after slowing sharply last year while lenders sorted out foreclosure abuse claims.
Now, this is probably something that a lot of people don't know about. There was actually 2 separate moratoriums on foreclosures, and these moratoriums come down from HUD. They come down from Fannie and Freddie, the big servicing companies that are processing all the foreclosures. The first one they did right after the crash, just because I think it was a point where they just weren't set up to handle as many foreclosures as they needed to get through. And that one lasted almost a year. Now, this latest one, and we started talking about it back in 2009, was because of the quote-unquote robo-signing mess. And basically, what caused the robo-signing scandal mess, however you want to put it, was that the big servicing companies set up these foreclosure mills, if you want to call it that. These are companies that the only thing they do is foreclose. It's almost like they're slamming through one foreclosure after the other. Now, come to find out, in a lot of states, these foreclosure mills were not actually performing the foreclosures properly. So there's a bunch of lawsuits, against the servicing companies, against the big banks, saying you didn't foreclose, I want my house back type thing. And this caused basically another moratorium nationwide on any new foreclosures. Now at this point, it does look like all the banks and these companies are getting through this robo-signing mess, and they're getting in a position where they're going to be able to start foreclosing more.
And even though Missouri is considered a non-judicial state, meaning that basically you don't have to get up in front of a judge to perform a foreclosure. Judicial states, California, New York, were affected more. Florida were affected more by the robo-signing mess. But whenever big banks, institute a moratorium,
the banks that are doing them all anyway.
When there's a moratorium instituted, it slows everything down. So foreclosures rose 8% nationally last month from December, but were down 15% from a year earlier, and that's according to Realty Track Incorporated. Now, again, talking about the St. Louis market, what's going on in our market, and this is actually a story that we were really excited about. Washington University is proposing an $80 million expansion in the Delmar Loop. And Delmar Loop is actually right down where University City and the city of St. Louis come together.
It's in between University City and Central West End.
A bunch of old buildings down there. I mean, there's a lot of old real estate down there that needs to be revitalized. And according to what this story, Washington University is going to dump $80 million into that area. They're going to rehab some buildings. They're going to maybe put up some new buildings for student housing and so forth.
We really like that because that's an area that has a long way to go. I mean, some of those neighborhoods around WashU, especially as you get up on the north side of Delmar, you got some really rough streets up through there.
And it's right in the heart of St. Louis, of the city of St. Louis, right in the middle of everything.
So we think that this is going to go a long way. Something else that was pretty exciting about this story to us is the fact that WashU spent 3 years doing research on it, and they felt that it was economically viable for them to put this money into St. Louis County, St. Louis City down there. We think that there's a lot of smart people at WashU. They're probably smarter than us, so we like it.
So we thought that was a really cool story and something that obviously a lot of people in St. Louis are excited about.
For sure.
For sure. So anyways, that is our market watch for tonight, and what we want to do next is we want to go ahead and introduce Mike Favazza. This is just a little bio about Mike. He graduated from Rosary High School out in Spanish Lake. Isn't that where Rosary is? And the University of Missouri St. Louis. Mike's been a certified public accountant for the past 23 years, worked in public accounting for most of his career. He definitely can supply a vast array of accounting services for all small businesses and individuals through income and estate tax preparation, consulting, and planning. Working with small businesses from the beginning stage of development, the business plan, to design effective accounting and reporting systems. Michael specializes in a complete line of accounting services. He will establish accounting records of the small business using QuickBooks, which is something that we've instituted in our business. Yep. QuickBooks software, and provide the training, coaching, and rectify inaccuracies to ensure precise reporting. Michael can give small businesses the benefit of the high level of financial management and the role of a chief financial officer without the burden of the cost of a full-time CFO. And that's really something that we really count on Mike for.
Mike's been our eyes and ears, dealing with the IRS for the past several years, and he's done a great job. So, Mike, thanks a lot for taking the time to talk with us tonight. We do appreciate you sacrificing one of your evenings. It's probably your busiest time of year as you're preparing all those tax returns. And what we wanted to do is to bring you into the presentation, Mike. We just wrote a couple questions. These are questions that that a layman would think of. We sat down actually and thought these questions, but we thought that you would really do a great job answering and explaining these questions. So we're going to get right into the material, if that's okay.
Okay.
First question, obviously this is a softball one. How does owning real estate help individuals build wealth?
Well, in your personal residence, you buy it, you pay it off over 30 years. Hopefully it appreciates in value. In 30 years you've got it paid off. And then if you choose to sell it, the IRS allows you to not pay tax on the first $250,000 of profit as a single individual and $500,000 of profit as a married individual. So that's a huge tax break for people on their personal residences, that as they sell and as they move up and as the buildings appreciate, they don't have to pay tax on it. So that's a huge way to build personal wealth. And then as an investment property, one of the advantages is you get to use other people's money. You get to borrow money. You have to put a down payment down of your own money, but you get to borrow money and to buy that building, and you get to depreciate it and write off all the expenses and so on. And then over a period of time, real estate has always appreciated in value, so you're building wealth that way by using other people's money. Right now interest rates are the lowest that I can remember. So now, might be a good time to buy because interest rates are low. Real estate usually appreciates in value, and you can borrow money to make these investments and increase your wealth.
That's something that always really intrigued us about buying rental property, is that as long as you do an effective job managing it, you can have somebody else pay off your own debt. So it's like over the long haul, as long as you're committed enough to stick with the project, if you can stick with it 10, 20, 30 years, then you're really going to be doing yourself a favor.
Sure. The key is to get the right tenant to make sure you know your numbers and that you're charging the right amount of rent to pay your costs. But you're right, your tenant pays it off for you. So that's a huge advantage.
So Mike, what are the tax advantages of owning real estate in the short term, in the long term?
Well, as rental property, you get to depreciate the cost of that real estate. Cannot depreciate land, but you have to, you're entitled to depreciate the cost of the building and any appliances that are in the building, any land improvements you might make to the yard and so on. You get to write all that off, depreciate that over a period of time, again, while the tenant is paying you rent. So while you have to record the rental income as income, you get to deduct from it, the interest expense you're paying on the loan, the real estate taxes that you're paying on the property, utilities you might be incurring out of your pocket, any other repairs and maintenance that you're making, mileage for driving back and forth, checking on the rental property. You get to write off a whole lot of items, being an owner of a rental property.
Mike, are there different depreciation schedules depending on if you're talking about your building versus your appliances versus personal property?
Yes. A residential building, you have to depreciate over 27.5 years. A commercial real estate building, you have to depreciate over 31.5 years. But appliances can be depreciated over a 5-year period. So when you're buying a piece of property, and it might include some appliances, try to get that separated in your contract so that you can identify what they are and assign a cost value to them, so that when your taxes are prepared, you can depreciate the appliances a lot faster than the cost of the building.
And then for us, that's certainly the advantage of using, Mike to do our taxes, to have a good CPA, is we can say, hey, Mike, we bought a new stove for such and such property this year, and automatically it's done the correct way. Obviously we're not going to know the tax law like Mike does, but you definitely, I guess this is just another point of our whole webinar, is you need to count on somebody to know this before you do it right. For sure. Okay.
Yeah, I think a lot of times, just to add to that point, whenever we're sitting down with someone that is interested in buying investment property, sometimes if you ask them, if they prepare their own taxes, and they kind of look at you like, of course I do, why wouldn't I? Mm-hmm. And the first thing that we say is, well, you don't want to do that.
Yeah, you need a CPA.
Yeah, you got to have a CPA. So it's something to consider for the new investor, or even someone that's been around for a while. As far as those depreciation schedules, Mike, will any of that stuff ever come back to haunt you whenever you go to sell? Do you have to pay some of it back whenever you go to sell these properties?
Yes. As you own the property, you depreciate it, and that's an ordinary business expense. Comes off your as an ordinary expense for taxes. So, but when you sell the property, you in effect have to recapture that depreciation. So you gotta in fact record income, back after the fact.
So is that coming like a capital gains tax?
The recapture of the depreciation comes back as ordinary income, but the appreciation in the value of the building is taxed at capital gain rates, which are lower. So,
Okay.
for example, if you bought a building for $100,000 and then 20 years down the road you sold it for $200,000, well, you got a $100,000 gain, and that is taxed at capital gain rates, which are a lot lower than the ordinary income tax rates. So that's another advantage of investing in investment properties, is that you get preferable tax rates on the profits of the properties.
Excellent. Does the capital gains rate, does that change as you hold on to a property over time?
It can. You know, Congress changes rates all the time. The maximum capital gain rate now is 15%. For people with lower levels of income, it can be 0%, but it will not be more than 15%.
Between short-term and
I was going to say the ordinary income tax rates, the highest are 35%.
Yeah.
So the capital gain rates definitely are an advantage.
Let's hope they keep it that way.
Yeah, no doubt.
Yeah.
So this kind of just goes into our next questions, and I know you've already actually spoke on this a little bit, Mike, but any difference in write-offs for investment property versus primary residences that people should know about?
Well, you know, the primary residence, you know, you can write off your mortgage interest and your real estate taxes. You can do that on investment properties too. On your primary residence, you cannot deduct your repairs and maintenance and your utilities and fix up expenses and so on. But on an investment property, you can. So an investment property is a business, and generally any expense relating to your business is deductible as long as it's ordinary and necessary. So if you have to incur an expense to spruce up the investment property, it's definitely deductible. If you have to advertise to find a tenant, that's deductible. If you have to fix the plumbing, clean the carpets, pay utilities, that is all deductible. So there's definitely a lot more deductions for investment properties versus primary residences.
Fantastic. And what items, when you talk about appliances, is there any other items, you know, land improvements, anything like that, that can be depreciated other than the mortgage insurance?
Yes, you know, shrubbery, sidewalks, you know, land improvements like that can be depreciated over, I think it's a 15-year period as opposed to 27 and a half.
What if you put a new roof on?
Well, there's a couple of schools of thought on that. When you bought the house, it had a roof on it, so that's included in the original price. So by you know, replacing the roof, you're just incurring a maintenance item, you know, and deducting that.
Okay, real good, real good. Here's a question that I've actually been asked before. Does the percentage of deductions differ depending on how title is held on an investment property?
No, it really doesn't. Again, an investment property is a business. Any expense incurred is deductible, you know, on a business, as long as you're attempting to make a profit, you know, raise revenue and make a profit. So titling the property really does not make a difference. It can be held in your individual name, it can be held in a limited liability company, it can be held in a corporation. Still, an expense regarding an investment property is still an expense.
And do you have any recommendations as far as what the best way is? You know, I mean, there's a lot of different. I've got a lot of different opinions on that too. You know, are you better off holding it in an LLC or an S corp? I know it depends on the type of financing that you're seeking, also.
Right. The issue is you know, legal liability protection. You've got an investment property. You're not there all the time. You don't know who's coming in and out of that property or what could happen. A fire could destroy the entire house, injure the people, injure the property next to them, and so on. So you always want legal liability protection. So you should, you know, buy that property within a limited liability company, an LLC. Those are the easiest to set up. less costly to set up. By putting the property within a LLC, it protects your personal assets from any lawsuits resulting in damages to the property.
So it's just like a liability aspect and not necessarily going to change how you're going to handle your tax write-offs.
That's correct. Again, expenses relating to investment property are deductible no matter how you title the property.
Okay, fantastic. And then what about tax allowances for flipping property? I mean, this is obviously something that we've helped investors with for years and years now. A lot of people are really interested in flipping property. They don't necessarily want to be landlords. And we're landlords, so we understand that.
Right.
But from what I've been told or been taught through the years, being a landlord has more tax advantages than just purchasing a property, fixing it up, and then resell. Can you expand on that a little bit, Mike?
Well, people that flip property, they're in the business of, making profit by flipping houses, and the IRS considers that to be ordinary income. So if you buy a house, fix it up, flip it at a profit, that profit is ordinary income to you, added in to the income, other income you might have from your W-2 interest income and so on, and you pay ordinary income tax rates on the profit from flipping a property, as opposed to an investment property. When you sell it, the profit would be subject to capital gain rates, which are a lot lower.
So it does depend on how long you own the property, what type of capital gains rate you're going to pay?
Well, on flipping property, there's no capital gains available. It's considered a trader business. Trader business, the profits from a trader business are subject to ordinary income tax rates. Okay.
What if it takes you a year and a half to sell it? Does that change anything?
No, it doesn't, because you have established that you're in the business of flipping houses. The IRS says that's that's an ordinary business subject to ordinary income tax rates, as opposed to an occasional investment. Buying a rental property, that's definitely an investment.
Well, that's great information. I'm going to move right along to our next question. And, this is, again, something that we kind of joked about at the beginning of the presentation as far as, keys to staying organized.
Yeah, when we first met Mike, I think we walked into his office one spring with our shoebox full of receipts.
Yeah, that was a great one.
I remember that.
Yeah, from then on, Mike's always super happy to see us every year.
Oh, yeah.
But what we've tried to do, and, like the chair mentioned earlier, we felt like we definitely made some improvements. We're trying to run our business the right way, stay as organized as we possibly can, and not get ourselves to a point where we're waiting till the end of the year and totally playing catch up. So if you could, just give a little bit of advice there, Mike.
Well, I see this problem with every business that I represent, whether it's in real estate or any other kind of business. Business owners get frustrated because of the record keeping. My answer to that is use one checking account, use one credit card, for your property or your business. Do not commingle personal funds. Don't pay certain business expenses out of your personal bank account and vice versa. Because at the end of the year, when it's time to accumulate your numbers at tax return time, you're going to miss something. You're going to get totally frustrated because you're searching through different bank accounts, different credit cards, trying to identify, what is a business expense and what isn't. The easiest thing to do is to get organized. And I tell people to use one checking account and one credit card and one debit card, for each business. That way it's easier to track expenses, income and expenses, and at tax return time, everything will be accumulated very easily. Not to mention, during the year, if you keep your books right, and I suggest using QuickBooks, put everything in the QuickBooks. During the year, you'll know if you're making a profit or a loss in your business, and you can make decisions from there, whether or not you have to raise rents or cut expenses or whatever.
Yeah,
that's a great point. I mean, having a profit and loss statement for any business owner is very important, and that's that's something that not everybody does just because they're not as organized as they should be.
I would say businesses having issues with organization, whether it's a real estate business or you're an investor or whatever the case is. I mean, you could be selling shoes, but I think businesses that aren't organized, that's probably the biggest factor, and then not being able to expand their business, not being able to grow the business. Because if you're not organized,
exactly.
You're small, how in the world are you going to be organized whenever you're growing?
Right, and I tell clients, I mean, yes, I want to use QuickBooks. I want the numbers organized. I want a creative chart of accounts that is descriptive and where the revenue came from, breaking down the expenses in pretty much detail. But I tell clients, use that as your marketing tool. Now you can see where your revenue is coming from, where your marketing or where your expenses are going, and you'll know during the year where you stand profit or loss wise. And if you want to make X amount of dollars to put in your pocket at the end of the year, then you can see how you're doing during the year. And if you're not doing enough, then you need to change your marketing. You need to get more customers, raise your rents, or reduce your expenses. But good financial records drives your marketing.
Absolutely.
Yeah, I couldn't agree with that more. How do you know what money to spend or how much money you need to spend if you don't know how much money you're going to make?
You're gunslinging if you're doing it any other way. And I guess the idea here is that once you are disciplined enough to get all this working and get it the right way, it's really not that difficult because it's just something that you stay up on a daily basis rather than continually trying to play catch up.
And again, it gives you the tools to manage your business. I mean, whether you want to sell more houses, whether you want to buy more properties and be, to rent out, whatever the case is.
Absolutely.
And I know people with several rental properties, and we use QuickBooks, but we have a separate, what QuickBooks calls a class or a department within QuickBooks, so we can have income and expenses by each property, so it's not all commingled together, so they can identify perhaps one property doing bad and the other doing good. So I'm a big proponent of good record keeping.
We are too, and that's one of the reasons why we like doing business with you and your company, Mike, for sure. We kind of hit this next question as far as the specific software that you recommend for bookkeeping. This is important. Are there any other professionals that you recommend a property investor consult with? Maybe somebody's just getting started in the business. Who else do they need to talk to besides, obviously they need a good real estate agent.
Yeah, that's key.
That's key.
Yeah.
They need a good CPA. We've been talking about that tonight. But is there any other professionals that people need to consult with prior to buying?
Well, they probably need a good lawyer that understands, real estate, that can draft effective leases. I mean, yeah, you can find leases on the internet. You can buy them at the office supply store, but they're pretty generic. I think a good lawyer with some experience in representing others that can relay some bad stories that have happened to other people is good to know, and can put certain clauses in leases that will help you and give you power and authority to do what you have to do. So a good lawyer that knows real estate, I think is very important.
Yeah, I couldn't agree more. Those one-page leases are a little scary.
Yeah, they don't get the
Sure.
Yeah, we've seen those before, where you go to Office Depot and it's just a couple paragraphs, and you're like, I don't know if this is really going to cover me correctly. So
right.
That's real good advice. Any other steps that investors need to take before buying, in your opinion, Mike?
Well, it gets back to financial records. As investors, shop for property and want to buy property, I've seen it a lot where, they go to the bank to try to borrow money, and the bank, wants personal financial statements. The bank wants financial statements on existing businesses or rental properties. That's how the bank gets to know you, the investor. So clients that don't have their personal financial statements in order or their business financial statements in order are really hurting themselves, because they walk into a bank and they look unorganized, and the banker has a bad feeling. So It really pays to get your books in order, your financial statements in order, and then when you're ready to buy something, you've got the material in your hand, and the banker then knows you from your financial records.
And that's a great point. I mean, one thing that everyone's encountered as far as purchasing real estate is the funding is so dry right now. You know,
Sure.
Funding's dried up. It's hard to get loans. It's hard to get banks to give you money to purchase, residential property, commercial property, whatever. And if you can go in and kind of hammer it on being organized, and you have a good P&L statement, you have all your records together. I agree 100% with that point, Mike, for sure.
Well, at one point, the money was too easy to get, obviously. And that's the reason that there was such a huge downturn in housing in our country, and the reason that the real estate market crashed. Now, at this point, I mean, these banks, it's almost like in some cases they don't want to loan people money to buy housing anymore.
They're real scared.
So if you can get yourself in a position where you can get funding and you can actually buy, then you're really doing yourself a favor, because you're buying houses that the prices are way beat down right now because of the fallout of the market. So if you can get there, if you can figure out a way to buy, if you can get your mortgages together, now is a great time as far as we're concerned to get into the market and go out and buy some real estate.
And if you own, properties already, again, have your records in shape. Show the banker that, what your income and expenses are on your current properties, and that you know what's going on and you can anticipate certain things. He'll be more inclined to consider your request because you know what you're doing. People that come in with shoeboxes don't give that impression,
No doubt about that.
Yeah, we learned that the hard way.
Oh yeah, oh yeah. Well, and Mike, we want to just thank you. We really, really appreciate you taking the time to present with us tonight. The information has been awesome. Can you tell everybody out there, maybe give them your direct number, your website, tell everybody a way that they can contact you if they need to talk to a really good CPA?
Well, sure. I'm located at 1811 Sherman Drive in St. Charles, Missouri. My phone number is 636-916-1010, and I have two websites. One of them is FavazzaCPA.com, and the other is TaxSt.Louis.com.
Fantastic.
I think a lot of good information on my websites that tells more about my company and what we do and so on. So.
Okay, fantastic, fantastic. Now the presentation tonight was recorded, so if anybody out there listening wants to share, just contact us at the YUEDE team. It's going to be on YouTube. It's going to be on iTunes again. So we'd be happy to send you the email link, and you can spread it around, share it with other investors.
Else that might benefit from some of the material.
So thanks again, Mike. We appreciate it a ton. We'll see you soon. We'll be in getting ready to prepare our taxes. That's always a blast. And no shoe boxes, we promise.
All right, great. Thanks, guys.
Thanks, Mike. Have a great night, man.
Take care, Mike.
Good night. Bye.